started.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. So, as you know, the Fed had its highly anticipated June FOMC meeting. While some of the actions were expected, some actions and comments came as a surprise. So, I am very excited to have on an industry expert who is going to help make sense of the Fed's actions and comments and the impact those actions and comments may have on bonds, equities, and the economy. I'm sure it's going to be a very insightful and timely conversation, and one that I know I'm really excited for. So with that backdrop, I think you all will enjoy today's guest and learn a lot, as I know I will. But first, today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. So with that, let's move on to the start of the show. Enough from me. I would like to welcome Max Wasserman. Max is the founder and senior portfolio manager at Miramar Capital. Prior to Miramar, Max was the senior portfolio manager at UBS. So thank you so much, Max, for joining the show. Max, tell us a little bit more about yourself. That was a very quick bio. Anything else that I didn't include in the bio above?
Well, first, thanks, Ryan, for having me here. You know, it's my background is more of a combination of managing discretionary portfolios and a research analyst. So I've been in this industry for, I don't want to date myself too much, but since my early 20s. So let's just say 30 years up plus.
I was just going to say 10 years.
Oh, you're very kind. You're very kind. It's going into Friday, a long weekend. So, I mean, I appreciate that. What we see is my background's been research. I've done research in energy, consumer staples. I'm an avid Fed watcher, and we manage money for high net worth individuals. My background is, again, research, portfolio management, sometimes perplexed investor like everyone else with the Fed. So I just want to throw that in there. And so I've been doing it. I've worked at LaSalle National Bank for like 7 years as a research analyst. I did valuation studies, mergers and acquisitions in my first start in my career. So I've done a lot of financial analysis, let's say, over the years.
Great. I love the that you threw in there you're an avid Fed watcher. So that fits right in with this discussion. So let's start there.
Sure.
As I mentioned at the opening, the Fed held its highly anticipated June FOMC meeting. At this point, I'm not really sure why I say highly anticipated, because at this point, they're all highly anticipated with the Fed, driving markets. So while the Fed kept rates unchanged, there are a lot of hawkish signals and tones, such as Powell saying rate cuts are a couple years out. What do these actions and comments from the Fed mean for equity investors?
Well, I think there's no surprise on one end, right? The equity investors have been jawboning. I use that. They've been talking the Fed into not raising interest rates anymore and waiting. People have to realize that every time the Fed raises interest rates, it's anywhere for 3 to 6 months to work itself through the economy. Before you start seeing real effect, your mortgages go up, people who have to refinance, their credit cards go up. So it takes a while to work its way through the economy. So with all these tremendous Fed hikes, that everybody's asking them to slow it down a little bit and let's see the effects before they continue. So everybody knew. I mean, if you didn't know, then maybe you're on Mars. If you didn't know he wasn't going to do it. I think the wrinkle was the fact that he said we see maybe another one or two because we still see inflation's embedded. So people are wondering what's going on with this Fed. So I'll be a little facetious, but I don't know if anybody's seen a cartoon, Mr. Magoo, right? But I would date myself. But if anybody gets a chance, go see Mr. Magoo. He was a very kind older gentleman who wore big glasses, and he drove forward looking in the rearview mirror. I mean, looking backwards. And that's really what this Fed is. People have to remember that this Fed has not been accurate at all in any of its predictions since the 10-year Powell of when GDP was going to grow, when inflation, everything. So anytime I hear the Fed make predictions of what it's going to do, I take it with a grain of salt because He hasn't been right. He
Mhm.
literally has not been right. Uh, people forget just a year and a half ago, December of 21, he was saying inflation was temporary. That was when the 10-year treasury was 1.5%. And then he changed his mind. I'll
Mhm.
take you back to 2018. 2018 of December, the Fed was like really concerned, raised interest rates when nobody wanted them to. And people remember the NASDAQ was up, but around Christmas, it dropped 1,000 points. And the
Yeah.
Fed had to reverse its course. So the Fed is not really good at basically predicting the direction of interest rates. But that being said, we know that he's near the end. So I think that's what everybody's counting on. And everybody thinks that if time goes on the next 30, 60 days, inflation will start to come down, which we're starting to see signs of it, and that the Fed won't do it anymore. And then hopefully Fed tightening, which is really the issue, what people have to realize, raising interest rates is tightening credit, right? It
Mhm.
makes it more expensive to get, harder to borrow. And that's really what's happening. And they're hoping that he'll stop that. Actually, a lot of Wall Street was hoping that he would cut interest rates by the end of the year, right? So think about that for a moment. They weren't just hoping that he would stall, but he would reverse. So his
Mhm.
comments of raising another one or two times really takes cutting interest rates by the end of the year off the table, I think. And that's one thing you can count on is I think rates are going to stay here for a while. Whether he raises another one or two, I think he should have raised yesterday, the other day, because if you're threatening to do one or two, just do one and hold,
Yeah.
right? Just get it off the table and say, listen, I think we're going to be done. We'll wait and see. But that's not his style. He's very political and he's trying to be a tight walker on a rope. So I would say at this juncture, I would pay less attention to what the Fed is saying because we know the Fed is almost done. When he's done, we're not 100% sure because he doesn't know.
Yeah. That's fantastic, Max. Great commentary there and some great insight on the Fed. You brought up a very good point. You don't really trust what Powell is saying, what the Fed is signaling, and their famed dot plot graph that everyone
Yes.
points to is
Right.
signaling a terminal rate of 5.6%. That's means another 50 basis points worth of hiking. And I agree with you. If they're looking at 50 basis points, why didn't they just do it and
Do a
get
quarter. Yeah.
with, right? Like rip the band-aid off. Do you think interest rates will reach those levels? I think you might have answered this question earlier. And if so, what type of impact will it have on the economy and fixed income and equities?
Well, let's just do a brief. I don't want to do a classroom, but briefly, what does the terminal rate really mean? A terminal rate is trying to say it's neutral. It's neither expanding or contracting. That's the type when the market is pretty much full employment, everything's working fine. So they're guessing. They're usually, I have to tell you, go get a Ouija board. Again, I'm dating myself, a Ouija board, and you're going to have as much as the Fed do. So I'm not shy about bashing the Fed at times. He did the right thing by raising interest rates, but now whether he's going to do another 50, I think the economy is slowing down. We're seeing signs of slow down. But the thing that's throwing the Fed off, completely off, is employment. Inflation is embedded in employment, and that's not going away for some time. You have the unions, the railroads, you have across the board with even UPS and everyone who is resetting salaries higher,
Yeah.
inflationary. It's hard to get workers, inflationary. And we're not really seeing signs of inflation coming down in employment. And so as long as employment remains low, which unemployment low is a good thing, but inflation embedded is going to cost. The second thing is supply chain is still not 100% to where it should be,
Mm-hmm.
right? And the Fed cannot control the supply chain. That's what they just can't do it. They can control the cost of money, but they cannot control the supply chain. So there's embedded inflation in the process that they can't control. So I think you'll see. I'd like to see them raise another quarter. I wish they would have done it now. But by the way, it's very hard. It's very hard for them to say in July or August, you know what? We see inflation. We're going to go back and start raising. If they were to do like that and start saying we're going to raise it one, two, three times, right? That would be bad for the market. That would be a problem.
Mm-hmm.
And because the market valuation now is not cheap by any metrics, not in this environment. At 19 times earnings, the NASDAQ is overvalued in our opinion. So if you were to start raising the interest rates, that would be negative for that part of the market. But I think what you're going to see is you're going to see the economy start to slow down. The Fed should raise another one time, but
Mm-hmm.
it's hard to say. I mean, The momentum has stopped, and to restart that momentum, it's a lot of political criticism. And I don't know if he's up for it. He's been reluctant in the past to fight the politics.
Yep. Great point. You brought in inflation. We can't really have this conversation with, talking about inflation like you did. And you brought up some great points about, employment, inflation, and wage growth probably isn't slowing. And, the labor market is still remains very tight and strong, like what you said is a good thing. Maybe not so much with inflation, but will the Fed be able to get inflation down to 2%? Or will we see long-term inflation around 3%? And what else is interesting too is, before it was very globalized. It was a very global economy. That's changed a little bit. Now it's more isolated economies. That might hurt bringing inflation down. So what are your thoughts on long-term inflation?
Well, I think if you look at, the ECB raised interest rates the other day, and they're saying they may raise further. So Europe is experiencing inflation. I would like to take the Federal Reserve Board on a field trip to the grocery store, and I would like them to start buying groceries and really see what inflation is. And yes, it's come down in the price of eggs, but milk, meats, all that are still high. So I think it's going to be hard to bring it down to 2% inflation rate as long as employment is this strong. The only way I think you get inflation down is if unemployment were to start to rise and rise significantly. So do I think they'll accept a 3%? Yes, I think they will. I think they'll accept the 3% in the hopes that there'll be equilibrium at that number. People have to remember there's trillions of dollars sitting on the sidelines. It's trillions in short-term treasuries. I mean, you get a 3-month treasury, you get a 1-year treasury, you get 5%, 5.25%. People are like, they put a lot of money in that area. And that money is usually money that earmarks for the stock market. So I think there's a lot of buying power still there, but inflation is going to be, I'll split it. I'll say 2.5 to 3. And I think it's going to be there for a while because I think it's going to take a while for employment to really change because people don't want to take too much of a risk. I mean, you hear all the layoffs, by the way, in technology, right? You hear all layoffs in tech, but the unemployment rate in technology is like under 3%, even with all those announcements.
Yeah.
So you're going to see, I think you're going to see the economy slow down. You're going to see unemployment start to rise, but it's going to take a while. And I'm going to introduce a word that we've been calling for a while called stagflation. And we think that's more a thing where you have a slowing economy and just inflation is here. And that's going to take, I think, about a year. Another year from now, you could see inflation down to 2.5%. But I think it's going to take a while. You got to get employment. The market's too hot. Even the real estate market and pockets are still too hot because of lack of supply. So I think we're going to be there. And I think the Fed, again, they're in the 8th inning of tightening, whether they do another 1 or 2. I mean, it's just, to me, it's not material if you're going to push it out now, unless you go crazy and raise it 3 or 4 times.
Yep. I completely agree. And one thing Powell has said is, for a while now, there's more pain is needed, especially in the labor market, right? And I agree. Unfortunately, more people are going to have to lose their jobs. And it's interesting. Well, the pivot here and talk more about markets and equities, but it's interesting how equities, to me, have performed so well this year when you consider the Fed's not done raising rates.
Right.
They remain hawkish. And then
Right.
you also have, like you said, a slowing economy, right? And that economy may continue this slow. You're looking at the labor market where the Fed is trying to slow the labor market, yet the NASDAQ is returned over 30% year to date. Are you getting a sense that investors are too bullish given the strong performance? And that strong performance has been driven by the Magnificent Seven tech stock.
Right.
Or are your clients still unsure about the health of the economy and markets? What are you telling your clients?
So you have a great analysis there. Let's take a step back to last year. Last year, the S&P was down about 20%. The NASDAQ was down about 32%. Right. So the NASDAQ, and by the way, all the S&P 500 has become is a miniature NASDAQ 100. So people have to understand that the top 2 stocks, Microsoft and Apple, are almost 14% of the S&P weight. So, S&P, when the S&P was down 20, the NASDAQ is down 32. If you fast forward to this year, reverse it. So now you have the S&P is up 14, 15%, the Nasdaq's up 31%, and it's the same seven stocks. So eight stocks. So this technology stocks that got killed last year. I mean, killed. You're looking at Microsoft was down, Apple was down, Nvidia was down, Broadcom, Amazon, Google, they were all down. Those now have done reversal.
Mhm.
But the equal weighted part of the market, if you look at that, is up about 4 or 5% for the year right now. And it's really been dominated right now by a handful of 7 to 10 tech stocks, and the market's trying to broaden out. So while you look at it as the market's been great, if there's 500 S&P stocks and only 7 to 10 are up for the year, and the rest are flat to maybe negative, it's not been that good in the stock market as the surface would seem. So we think the market is really heavily concentrated. Now, I think part of the reason they run is a few reasons. One is like, again, rates have gone up, but there's a mania called AI right now, artificial intelligence. And if you put your name AI next to anything, this thing is running right this moment. And I'm not saying it's comparative to the dot-com craze of the late 90s, dating myself, but everybody's trying to sit there and say, I have AI, right? I have AI for consumer analysis of their spending. I have AI for if you want to get a cup of coffee, telling me. So people are really excited. It's crazy. I mean, I went to the grocery store and I see, okay, AI will determine what you're going to pick next. I'm like, okay, right, this is getting out of control. But these are great companies still. I mean, we have investments in Microsoft and Apple. We still like them, but this has gotten a little crazy to be up 40, 50% for the year. It's just a reversal. It's a reversal of what happened last year. And we think they're pretty tired, actually. They may go up a little bit more just because momentum. But again, I think the market has to broaden out. And a lot of questions we get from clients is they're wise. Again, we're dealing with a high net worth crowd. We're dealing with small investment pensions. We're doing small companies that we deal with. So they're like, wait a second. We hear that it's only 7 or 8 stocks. Is this dangerous for the market? And historically, when you have this type of separation, so you have a handful of stocks really high and the rest down here, one of two things have to come up. Either the other ones have to come up to it, or it has to come down,
Mhm.
right? We think it's going to be even. We think that NASDAQ will come down and the rest of the market will come up as the end of the year comes, right? And we think that will be because people will be looking for 2024 earnings as we get to the third and fourth quarter. But if interest rates were to reaccelerate, if the Fed turned around in a month or two and said, you know what, we're raising 1, 2, 3 times, NASDAQ's going to take it on the chin, right? Because that's really, you're discounting future cash flows, and that's what growth stocks do. But, again, I think the Fed does not want to kill the golden goose. It doesn't want to make it political. So the market right now in the summer, we have Fed, we know what the Fed's doing, we know what oil is doing. We have a good idea that the inflation's starting to come down. China's starting to open, which is good for the consumers, right? And now you're starting to see demand for our multinational products. People can buy a Starbucks now in China, which is good. You can sell clothing now, but supply chains are still backed up. They're still having issues. So I think this market right now is fairly overvalued. And the reason I say that is because the technology stocks are trading such high multiples.
You such great insight and information there. One thing I've noticed too is I've looked at that the gap between the S&P cap weighted index and the
Right.
S&P equal weight, and that gap between the two of them, it's never been this wide, with the
Right.
cap weighted just outperforming the equal weighted. And that is a little bit concerning, because if the Fed surprises these trades, as we know, Max, the markets move quicker than ever, right? In my 20 years or 20, we've
Right.
never seen markets move this quickly. I don't want to be on the wrong side of that trade. If that tech trade unwinds because the Fed increases 2 more times,
Right.
it's going to unwind quick, like you said, and especially when it's some might say it's not overdone, but if it is overdone, watch out. And we saw that, last year, the tech stocks performed so
Right.
well during the pandemic. What are some of the biggest risks you are watching moving
Well,
forward?
I think people have to understand the mechanics of this market. First of all, the ETFs exchange traded funds are really fueling this, because people throw money in, let's say, an S&P 500, like the SPY, for example, and they think they're getting a diversified, portfolio. What they're really getting is the NASDAQ 100 because, again, the top 5 stocks are mainly technology. So the more money you throw into these ETFs, these index ETFs, it just reinforces the top large cap stocks. So you're not really getting diversified. You're getting more of that weighting. Now, I don't have a problem owning it, but understanding the risk that you have with it. It's not an equal weighted part of the market where you're getting diversified among 10 different sectors. You're getting technology as a predominant sector. You're getting the top 5 tech stocks. So it's going to be over 20, 25% of the market is going to be in tech. And that's not a problem as long as you understand the volatility. So what we would say to people is understand what you own. The other thing that's really relevant here is there's now an alternative to stocks. There hasn't been an alternative to stocks for the retirees, the conservative investors for the past 8 years because the Fed's been cutting rates. So if you can only get 1.5% in 10 years, or you can get a stock market that's giving you an average dividend yield too and growth, you're going to go there. But now you can buy 1 and 2 year corporate bonds and get 5%. You can get a CD and get 5%. So if you're a retiree or if you're somebody who wants more cash flow and less volatility, they have an alternative. So they're going to be putting money there. Now, if the Fed were to reverse the interest rates and cut them, then that money would come back. But a lot of money's in the short term, and that's a competition for the market. And people need to realize that if I have right now, people have taken money out of cash deposits and they're putting money markets. Money markets are giving you 4.5, 4.7%. That's a real alternative to owning stocks. So individuals need to know what their risk tolerance is and how much they can be exposed. But if I'm going into the stock market, we're dividend growth investors. So we like dividends. I mean, that's our forte. So we like to get paid to wait. But you can buy a 1 year treasury, get 5.25. That's pretty attractive for a lot of conservative investors. And that, the market's got to compete with that. But right now, the NASDAQ is exploding. Right now, the S&P is very high. Everybody's jumping for joy that the good times could be here again. But they've been weary because they've gotten beaten up, and they should be. A lot of risk is still in this market because it's heavily concentrated. But the overall market's not expensive. I just want to tell investors, it's not. If you take out, right, those top tech stocks, consumer cyclicals, healthcare, financials, right, staples are a little rich, but those areas of the market are pretty inexpensive compared to their historical. So I just think you have to be very selective when you're building your portfolio.
Yeah, you made a great point there. And ETFs they're doing well. When markets are doing well, ETFs are passive investments, but when volatility picks up, stock picking becomes so much more important, like you said. And we could be getting into a period where stock pickers are very important, or good stock picking, right?
Right. Last year, the average, I would say, I know in our area of concentration, dividend investors did very well on a relative basis, right? I mean, typical dividend investors was down in the high single digits, mid single digits for last year versus the market. Good dividend investors, right? Was that.
Yeah.
But, in a runaway market, a rising tide lifts all boats, and there's no discipline, there's no nothing. You're just holding on as it takes everything, whether it's good or bad. So I think we're still in a stock pickers market on a long-term basis. But in the last 6 months, you just throw it at an ETF and it goes up because, again, it's market cap weighted.
Yeah.
And the top technology stocks are dominating everything until they don't. And like last year, when they didn't, you couldn't get out of them quick enough. People with ETFs were getting killed.
Yeah.
And people have a short-term memory, so they're going right back into it again.
Yeah. I want to pick your brain a little bit real quickly on dividend stocks. So usually, dividend stocks are great when the market is so it helps your portfolio add some diversification, some income, and provides, not security like bonds or treasury, but helps smooths out the ride. Is there, other times maybe dividend investing, investors should look at it?
Yeah, I mean, again, so we're going to talk our book in a way, right? So you always hear that phrase, So we look at dividend growth. So, in our portfolios, we try to target about a 3% average yield in the portfolio. But we have a lot of technology stocks that pay lower dividends, right? So you can get cyclical companies that are paying you 2, 3, 4% dividends, and you can get technology companies that are paying you 1, 2% dividends, but they're growing up. So we look for companies that have the ability to increase their the growth rate. They may not pay the high dividends, but when you combine them in a portfolio, you can still have companies like Microsoft, which is increases a dividend 10%, an Apple, a Broadcom, Texas Instruments. These are companies we own, but they're dividend growers. Now, they may not be the highest dividends, but when you add them with other companies, healthcare companies, you can get a good mix, good diversification, and you still participate in the technology market. But you're doing it through companies that have more established, corporate capital policies. That's all.
Great. Fantastic. I love that, the ending there. Real quickly, so fun story. Any interesting items that you've experienced? Before we started recording, you talked about Montana and Bozeman. We both love Bozeman. Any
Sure.
fun stories? It doesn't have to be market related, just something to fun to close the show.
I think it's what I find it's humorous and fun is we talked about it, is how the world has changed, right? All of a sudden we were like robots, automatons, we're going into the office, we work at our desk, we don't see the outside. And unfortunately, it took COVID to open our eyes. So now all of a sudden people say, wait a sec, with technology, we can live and work anywhere. And, you live in Tahoe, I love to vacation in Montana, and I can still work. And I think the interesting part is we now have what's called a quality of life issue. We want to work, but we want to enjoy life and we want to see nice surroundings. So I laugh at the fact that a lot of the major cities, and a lot of the major cities are raising taxes on the constituents while they're all leaving. To me, it's like the last one out of the major cities turn out the lights because everybody's going fishing and enjoying the quality of their life. So I find humor in that. I was mentioning to you, I love the picture on your wall there. I think it's wonderful what's happening. I think the quality of life long term people enjoy. But if you really think about it, if you look at all the major cities, they're raising your taxes and you're leaving. So I sort of laugh because when we talk to all of our clients and I talk to my friends, they go, "Where are you?" "Oh, I'm now out in the country." "Oh, I'm not in this area. I'm living in Greece and I'm working." "I thought you worked in New York City." "I live in Greece now and I'm enjoying life." So to me, I say, I hope everybody gets that opportunity. They have the ability to work remotely and they enjoy it. I mean, thank God for these opportunities we have.
Max, it's great. We've seen it in Tahoe numerous different ways. For people who have lived in Tahoe for 30 years, they hate it because now all these people are coming
Oh, sure.
from out of
They
town.
don't want you to ruin their state. Yeah, their cities.
Exactly. It's just blown up. The ski lifts are insane right now.
Oh, the ski lift tickets, I hear over 250 a shot now. Is that true?
It is. You would be shocked, Max, at the amount of money people, family four, how much it
Right.
costs to go skiing now up in Tahoe or Vail or something
By the
like
way, we talk about inflation.
Yeah.
Look at these areas. Oh my, renting a car. Last year I couldn't even get a car. I had to drive to Montana because renting a car was like $200 a day. I was like, oh my God, it's crazy.
Yeah. And it's different parts of the market that's causing inflation, right? That economists may not think about, right? Like the movement and people now being
Yeah.
able to work remotely and renting cars. You're exactly right.
Well, people have money, thank God, and they're spending differently. During COVID, they spent on their homes. Now people want to spend on right up. They said, let me go on vacation. Let me go this place. But travel, go to the airports, they're packed. Try to get a rental car, they're crazy. Hotels off the chart. So that's inflation to me. But my final comment would be I want to take the Fed shopping. I want the Fed to come with me to go shopping, and I want them to fill a basket of groceries themselves, not their spouses. I want them to do it, and then you tell me how does a family really afford this type of that. So meanwhile, you know what they're doing? They're going to Tahoe. They're going to Montana.
Yes, take them
So,
shopping and take them grocery shopping in Tahoe.
oh my, guess what? Interest rates would be they would raise interest rates immediately.
Exactly. That's great, Max. Great stories, fantastic insights, as I expected. Such a fun conversation. I'd love to have you on again. Maybe talk about separately managed accounts, dividend investing.
My pleasure. Look forward to it, Ryan.
So many different things we can talk about. So thank you so much, Max, for joining the show. Quickly, last thing, where can our audience get more information about Miramar Capital?
Sure. If you go to miramarcap.com and that you see it behind me, MIRAMARCAP.com. And we have a lot of educational videos that we talk about dividends that don't take too long to watch, maybe a minute and a half. Won't put you to sleep too quickly, but that's where they would find out more about our thoughts on dividends, the markets, and things like that.
I've watched a couple of those and they are fantastic resources. So anyone out there, I highly recommend it. A lot of great insights there. So
thank you so much.
thank you everyone for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Adjusted for Risk YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much and have a great rest of your week.